Just weeks ago, South Korea's Kospi Index stood as the best-performing stock market on Earth, surging nearly 200% over the previous 12 months. That growth was driven by unheard-of returns from technology giants. Samsung climbed over 500%, while SK Hynix saw its value jump by 1,000%, a tenfold return on investment that turned the market into a global outlier. But the momentum vanished in an instant. In a span of just 21 days, the entire index collapsed by 25%, erasing a quarter of the country's market wealth. The height of the panic came during a session now known as Black Tuesday. In a single day of trading, the Kospi plummeted 10%, one of the most violent drops in the history of the Korean exchange. To understand the scale of that panic, a 10% single-day drop in the U.S. would be the third worst day in American history, surpassed only by the 1987 crash and the Great Depression. This crash in Seoul highlights the behavior of financial mechanisms that the United States currently shares. Because both countries rely on the same models of market leverage and corporate concentration, the Korean collapse provides a specific look at how those risks can behave when the tide turns. The violence of the crash was a direct result of how the Korean market was structured. It rested on a fragile foundation of extreme corporate concentration and unchecked retail leverage. While the index technically tracks hundreds of businesses, just two companies, Samsung and SK Hynix, account for 56% of the entire South Korean stock market. This concentration makes the entire national economy dependent on the performance of a single sector. That concentration was fueled by 14 million retail investors. Facing an unaffordable housing market, many young Koreans turn to stocks as their only path to building wealth, frequently using personal loans and high-risk borrowed money to maximize their positions. The trigger for the collapse arrived from across the Pacific. Shares of the American chipmaker Micron dipped slightly ahead of an earnings report, creating a ripple of anxiety about the future of the semiconductor trade. In a market as concentrated as Korea's, that ripple became a tidal wave. Investors rushed to the exits, causing those two dominant chip stocks to plummet and dragging the entire Kospi down with them. This reliance on debt meant the market's record highs were a concentrated bet rather than a reflection of broad economic strength. That structure left the system vulnerable to even a minor external breeze. A standard market dip became a catastrophe because of a specific mechanism, the margin call. This is the moment where borrowed money turns a correction into an uncontrollable crash. When buying stocks on margin, dropping below a minimum balance triggers a margin call. Without immediate cash, brokers automatically liquidate your shares to repay the loan. This forced selling pushes prices lower, triggering more margin calls for others, a self-sustaining doom loop. The results were devastating. In just a few days, 1 in every 30 people in South Korea saw their investment accounts completely wiped out as the system sold their shares into a falling market. By relying so heavily on leverage, investors handed their decision-making over to an algorithm. A minor correction was transformed into an automated, unstoppable avalanche. It is easy to view this as a uniquely Korean problem, but the data shows that the United States is currently following the exact same financial playbook. The U.S. market is experiencing its own extreme concentration. The top 10 companies now represent 36% of the S&P 500, a level of dependency on a few tech giants that mirrors the structural vulnerability we saw in the Kospi. Even more concerning is the debt. American margin debt has climbed to 4.5% of the total U.S. economy. This leverage towers over peaks seen before the dot-com bubble and 2008 financial crisis. It is the highest recorded margin debt in American history. That number likely understates the real risk. It doesn't account for billions in hidden leverage within modern instruments like zero-day options and 3x leveraged ETFs, which provide even more fuel for a potential doom loop. The U.S. hasn't avoided the risks that toppled the Korean market. Instead, Wall Street has scaled those identical vulnerabilities to the highest levels ever seen. The market rests on a pyramid structure of AI-driven spending, where each level depends entirely on the one below. At the base, tech giants spend billions on infrastructure. That spending becomes record earnings for chipmakers, justifying massive leverage at the very top. This entire system is held together by a single thread, capital expenditure, or CapEx. If the flow of spending at the bottom tier slows down, the tiers above it have no support. That responsibility falls on a tiny group of companies. Hyperscalers like Google, Meta, Microsoft, and Amazon are the primary engines driving this trillion-dollar AI investment. We now face a specific breaking point. If just one of these hyperscalers announces they are scaling back their AI spending because the returns aren't materializing, the revenue loop for the chipmakers instantly breaks. The stability of the broader market balances on the assumption that these four companies will never stop increasing their budgets. If that spending slows, the artificial revenue loop breaks, dissolving the foundation for the entire AI trade.